The risk in bonds. The risk in bonds. It's I'm going to share with this information. It's incredible to me, and I guarantee you missed it, as did I, because you look at year-to-year returns, as do I, and you say, oh, this did that, and yet you overlook the actual intra-year returns. And I'm going to share with you the bonds. So part of my appearance, haven't showered yet, so I got my hat on. Anytime you see me wearing my hat means I haven't showered, so I haven't shaved, I haven't combed my hair, haven't done anything. Got my Pats hat on today with Pat the Patriot because we're playing the Redskins. The Pats are 4-0, and they've beaten the Bills, who are undefeated. Everybody else they've beaten had no wins, and the Redskins have no wins either. It's crazy. Buddy, talk about an easy schedule. All right, come on. All right, so let's. I want to read this to you again. I cannot. Now, look, there's some things in this book I absolutely don't agree with. But it's like a history of economic performance in the past. But what can you extrapolate from it? I don't know. But I'm going to share with you what happened in 1987. Because 1987, before, I thought was just a flash in the pan. Actually, it's funny to know. Hey, come on. It's funny to understand what actually flash in the pan is. The words and sayings we use in the modern vernacular, and finding out what their premise is, flash in the pan, is literally the old black rifle, not black rifle, black, man. But anyway, the old rifles of the old days, black powder rifles, and you just plug it down there and do like this, and then you just have a flash, and that'd be the round going down range. That's a flash in the pan. It just happened like that. And a flash in the pan is what we used to say. Something that happens very quickly, that you really can't repeat without some serious effort. That's for sure. But anyway, I just can't stress this book enough. I sit there and I read not even a chapter, probably 10 pages, and I just sit there and I think, and I just. It's amazing to me. Now, the problem is it's somewhat dated because it does go back to 2007. It was published in 2009. And so because of that, we don't have the last 10, 15 years or so of history behind us. But up until that point is remarkable. So I'm going to read you about a flight of dollar bills. What happens when people start trying to make the dollar, U.S. dollar, less valuable? And so... Let me premise this. So, I'll just tell you, I'm going to read this actually. All right, I'm just going to read it because I think it's incredibly interesting. If you listen to this via like a podcast, you'll find a lot of it. Look at my eyebrows, got to get loose. Look at that guy. Oops, that one right there. All right, so basically what happened was we had a guy named Walter Jones. He used to be a Democrat in North Carolina. I think he went to the Republicans. But he says in 2005 to Alan Greenspan, he says, if Japan owns over $700 billion of U.S. debt. Mainland China and Hong Kong together hold another $250 billion of U.S. debt. Mr. Chairman, he's asking Greenspan, who is the chairman. Mr. Chairman, the question is, if this deficit continues to rise, and it looks like we're not going to be able to do what it takes to get it from rising, which they absolutely haven't, what would be the impact on U.S. financial markets if Japan or China were to stop buying U.S. Treasury bonds? In effect, Jones was asking what would happen to U.S. interest rates if Japan or China sold their holdings of U.S. government debt. See, this is where a coup, I think, Jones actually explicitly asked what would happen if those countries stopped buying, and coup is extrapolating that to say not just stop the purchase, but actually to sell. I don't want to say it's disingenuous, but not buying is not the equivalent of selling. But I kind of see where he's going. But anyway. Greenspan's response was shocking. He replied, we have looked into that question, and I think that we've concluded that the effect of foreign borrowing of U.S. Treasury instruments has lowered long-term interest rates a modest amount. And therefore, if they were to choose to stop buying or to sell, so Greenspan addresses both, to stop buying or to sell, he doesn't say the and there, and I just, anyway, it's okay. I hate to nitpick here, but Greenspan says if they're to choose to stop buying or to sell, it would raise interest rates, but only by a modest amount. The phrase modest amount, going back to coup, implies an increase of, say, 30 to 0.5%. So basically 30 basis points to 50 basis points, 0.5%, a third to 0.5%. I was shocked when I saw this, and even considered the possibility that the federal chairman had grown senile. For the past 20 years, the U.S. government has feared a few things as much as a sell-off of U.S. Treasury bonds by Japanese or Chinese investors. Greenspan was also concerned about this possibility. Throughout the past 2 decades, the Fed and the Treasury officials with whom I've spoken were always worried about this danger. But in 2005, the government's view changed. All right. The dollar flight has happened before. So Richard Koo says we've been through this before, and this is interesting. The earlier concerns were well-founded about a concern of the flight from dollar, i.e. the Japanese and the Chinese selling their debt or not buying or a combination thereof. In the 1980s, for example, actions by foreign investors and Japanese investors in particular led to a sharp fluctuation in the U.S. interest rates. The most shocking instance was on March 25th, 1987, when the dollar fell below 150 yen for the first time ever. Fund managers in Tokyo were already nervous as it was just a few days before the Japanese fiscal year end. Listen to this. Only 6 weeks earlier, in February 1987, the G7 nations had signed the Louvre, O-L-O-V-R-E, that sounds French, Accord. So 6 weeks earlier, the G7 nations had signed the Louvre or Louvre Accord, effectively declaring that the dollar had fallen enough. The dollar had plunged from 250 yen to just over 150 yen in 17 months since the Plaza Accord was signed in September 1985. With the Louvre Accord in effect, few currency market participants expected the dollar to fall through the threshold of 150 because they passed this accord saying the dollar has fallen enough. We try to reduce the value of the dollar to get more of a balance for currency, for a trade balance. All right, hold on. Come here, buddy. They passed this thing, the Plaza Accord in 1985, to try to reduce the trade imbalances with the U.S. and all this. So we had, the U.S. had huge trade deficits. Japanese had huge trade surpluses, and they wanted to reduce the currency of the U.S. relative to foreign rates so they could have the U.S. more export. So the manufacturing sector could export more goods overseas and import them, which was having huge consequences on the value of the yen, the trade deficit, and all that, the trade imbalance. So they passed this thing that said, okay, a year and a half later, hey, looks like our actions have done exactly what we want. So now the dollar has dropped from 240 to 240 yen to $1 to now to 150. So it looks like we're good. So we're going to pass this thing, or we're going to sign this thing called the Louvre Accord, saying the dollar we don't need it to drop anymore. So few participants expected it to drop anymore, but fall it did. And just 5 days before the end of the Japanese fiscal year of 1986, in March 31st, the U.S. dollar continued to fall, even though they said it would not fall anymore. They didn't expect it. They're the smartest minds in the world. This sparked massive turmoil in the markets. First, Japanese investors who had been buying U.S. Treasury bonds suddenly had to reverse course. That caused a benchmark U.S. long-term interest rate to surge from 7.5% to 9%, or 150 basis points, in the space of just 6 weeks. It went from 7.5% to 9% in 6 weeks' time. What does that mean when the yields go up? That means the demand has dropped off a cliff and the price is dropping. Long-term interest rates in Japan over the same time dropped from 4% to 2.5%. As money flowed back into the economy. So they were selling their treasury bonds, the Japanese, and were buying more bonds in Japan. So basically they were leaving the U.S., the demand was falling off a cliff, thus the price fell off a cliff, and thus the yields increased significantly. On the other side of the world, demand for Japanese debt was increasing. The prices were going up, and the yields were dropping like a brick in water. Because when prices go up, the yields drop. And the reason for that is because the U.S. dollar kept falling, and thus the people who had denominated debt in the U.S. are losing their value or losing their money. So the dollar, meanwhile, fell to 137 in 6 weeks' time. It started at 240, went to 150. They said, okay, it's all good. And they thought that'd give it a quick bump to the U.S. dollar. No, it went the other direction to 137. Although the government statistics showing the amount of U.S. Treasury bonds bought or sold by Japanese investors are released with a 2-month lag, so no one knew what was going on other than market participants. They in Japan were fully aware of what had triggered the sudden move in U.S. and Japanese interest rates. But many in the U.S. bond market, including the authorities, did not have their eyes on developments in Japan and were under the impression that interest rates had risen because of domestic inflation concerns. At the time, foreign banks in Japan made their money in currency dealing because local banks had a stranglehold on lending to Japanese corporations. It's incredible. I was reading that. I said, holy crap. I was just reading a book, and I forgot what it was off the top of my head, by the guy who had written Shogun, and he was talking about this. It's crazy. Anyway, so again, the U.S., but many in the U.S. bond market, including the authorities, did not have their eyes on the developments of Japan and were thinking that the reason the rates were jumping through the roof was simply because domestic inflation concerns, when actually it's the exact opposite. The Japanese were selling their bonds because they did not want to have the dollar to continue to devalue. All right, so what does this have to do with anything? So I want to show you something here. All right, so this is the Vanguard Long-Term Treasury Fund, VUSTX. All right, so if we go to performance, so let's just look year over year, and we see down 13% in 2013, down 12% in 2009. Again, remember that this fell exact opposite of the stocks. Stocks got killed in 2008 and did great in 2009. Bonds did great in 2008 and did poorly in 2009. You can see again, we're going to 1999, it was down 8.6%. 1994 is down 7.0 because the Fed was raising. And then in 1987, it was only down 2.9. Wow, it wasn't down that much, 2.9. Oh, no. Let's go to historical data, and we're going to show you something here. And we're going to go historical prices, and what we're going to do, and there's my spouse. All right, this guy's getting ready to bark, so just bear with me just a second. Yep, it's okay. It's okay. We're going to go to we're going to go to 1/1/1987, and then we're going to go to 12/31/1987. I'm going to show you the prices on these guys and how the price you got smoked. So you thought you were only down 3% in 1987, but watch this. So we hit apply, and then I'll pause it for just a second. I'll be right back so I can go get Pablo to see his mommy so he doesn't bark like crazy. Hold on just a sec. Let's take a look at the historical prices of the Vanguard Long-Term Treasury Bond Fund. And because I tell you, this will not be reflected in the year-over-year performance. If you held it for the whole year, it doesn't matter. But the problem is, I think a lot of people disregard is the up and down, the wild violence of the share price. So watch this. All right, so we're going to go back, and we talked about when they passed Louvre, I think is how you pronounce it. March 25th, 1987, the dollar fell below 150 yen. All right, so let's go back to March 25th and see what the price of the fund was right there. March 26th, okay. So March 25th was Sunday. It was at 9:30. All right, so we got 9:30. And then we're going to go back to 3 weeks late. That's May. Excuse me, March 25th, right there. 10:31. So we're going to go back 6 weeks later. From March 25th is at 10:31 down to, it went to 8 something if memory serves. Let's see. 9:30, May. Right there, 909. So basically over the course of 8 weeks or so, it went from 10, March 25th, 31 to 909. 1031 to 909. So 1031 minus 9.09. It fell $1.22 divided by 1031. It fell 11.8% in that basically 7-week time frame. We'll just say 12% on price per share. That's freaking nuts, man. So if we go back to the high and the low in March 25th, it was at March right there, 1031 looks like that. No, it wasn't even the highest. 1041. Yeah, that's pretty much the high. We'll just say that's the highest. 1031. We got 1045. All right, so we'll just say 1031, but then it went down below 9. It went down to, there's 887 in September, 876, 871, 869 right there. 863. I think that's 850, 850, 843, 839. Look at that. 830. It went down to 838. So it went from 1041 to 838. That's $2.30 a share divided by 1041. That's a 19.5% decline in share price in about 6 months' time. That's stock market like. That's crazy. And now if you look, and then you got to factor in when did the crash, not the flash crash, but when the markets got hammered in October 1987. Look, I always was under the assumption there was no reason, it just happened. I never understood what the Japanese currency manipulation, what they were doing in the currency to avoid the U.S. debt, and I never understood that at all. And that's crazy when you factor in how much the long-term Treasury bonds got hammered. On top of that, what it did to the stock market as well, how it all just flowed because of the Plaza Accord in 1985. I just find that is incredible. I find that incredible. So now let's go back to the Vanguard. I think we got to go to holdings here. Let me see where Turkey, there is, good boy. Now here's what we're looking at today. I want to look at duration if we have it on here. Yeah, right there. Duration 17.41. What that means is for every 1% increase in the interest rate, this thing could drop by 17.41%. So that's a very, very risky bond to hold in terms of price per share. So 1% increase in interest rates, this could drop by 17.4. So we had an over 1.5% increase in interest rates in 1987, and the max it fell was 19.5%, which just goes to show you the lower the coupon, the more volatility there is. And this is perfect part and parcel for bonds. The coupon right now is not at 7.5 back then. I guess right now, let's see what it's doing right now. We'll hit summary. I don't know. It's probably 2.5. Yeah, 2.44. So we'll just assume that's the coupon. So basically, the 30-year Treasury right now is at 2.44 with a 17.4 duration, which means if it went up to 3.44, it would lose 17.4% of a share price just like that. Not likely to happen overnight, but it did. In 1987, it happened. It went up 150 basis points in 6 weeks' time. And the price per share fell 19%, though, but it fell 19% over the course from March until September. And the reason for that is because the higher the coupon, the less risky it is. It's just, I cannot stress this enough. The lower the coupon, the more risky bonds are, without question, from a violent price swing. And so in that case, we have a duration of 17, 1% interest rates on a 2.44% yield, and it inherently makes sense. 1% divided by 2.44, that's a 41% increase in interest rates. If it went up by 1% off what it is out now at 2.44, that'd be a 41% increase in interest rates. And thus a duration, the violent swing of the downside of the price per share is much higher than if it went up 1%, it was at 7.5. So 1% increase in interest rates was trading at 7.5 is only a 13% increase in interest rates. Does that make sense? Thus a duration risk is a lot lower when the coupons are higher. Anyway, incredibly interesting. Now, if you look at the year-to-date return on this guy, 19.43. I don't know what this the date as of is, but I mean, so again, you're not making. I mean, you could think you're making money or not. I mean, you could sell it, but you still got to reinvest the money someplace. But I mean, you're not making any money unless you're using that money to buy another good, i.e., I don't know, you want to buy a piece of real estate, pay off your mortgage, something like that. Then you made money. But if you're just reinvesting it, you're not making any money. I just find that incredibly interesting. I hope you do too. It's nuts to me how violent the share price on bonds can be without anyone knowing. And then secondly, it's also incredible when you think about what caused these things. None of this happens in a bubble. So the Japanese, the currency exchange traders and whatnot, working with their to avoid getting hammered and the dollar declining, they start selling their bonds and buying up their own currency, and that raised the Japanese yen. That lowered their yields. It sold off ours, it increased our yields, and now it's the exact opposite today. It's just it's incredible. What does that mean? I have no clue. What does that mean in the future? No idea at all. At some point, everyone says we're going to have to deal with the fact that our deficit's so high. I don't know that to be true. I don't know. No one knows, and they can say all day long at some point we're going to have to deal with it, and that's what he says in his book. And this is going on 12, 13 years ago. We're going to have to deal with the deficits. We've been hearing that for years. I don't know we have to. I don't know we don't. I don't know. But I do know one thing is that if the dollar was to get devalued, as we talked about before, in terms of that's an inflationary. If you have an inflationary risk, bonds are painful to own for sure. Inflation will eat up your bonds. And as we just saw right there, as the dollar was declining in value, the price of the bonds got hammered, and that will happen anytime it's an inflationary construct. And right now we're not dealing with it. Does that mean it'll go away forever? I don't know, and you don't know. No one knows. But I tell you, the one thing I do know is paid off your debt. All right, we'll see you next time.